we're joined here by Hedley Widdup. He heads Lion Selection Group. So welcome to Hedley. Thanks very much for joining us
G'day,
in
James.
our Melbourne office.
It's a pleasure. It's nice to see you. Thank you for coming over.
Thank you. So we try to have these recordings once or twice a year. We had Hedley on, I think the last time was about midway through last year.
Mm-hmm.
Lots happened in the market since then, I think. Particularly overnight, we might touch on that later in the recording. We've just had the China stimulus big announcement there with copper futures, I think, recording a sort of 4% bounce overnight. So a little bit to chat there, but that's all very recent. But first of all, I just want to cover a few questions about geology and maybe some site visits. And the first question I just wanted to throw at you, Hedley. So as we're both geos and we've travelled to lots of different sites, and when you're out in these sort of remote places and in the outback and the bush, I think you come across some interesting, maybe some bizarre events at times. So can I just ask you, what's your most bizarre event that you've come across?
Oh, so many stories. You can ask me, and I probably can't tell you the most bizarre, only to protect the innocent. But there's all sorts of interesting things you come across. In Africa, I was visiting a couple of copper prospects, and we're driving through a town. Stopped at an intersection where there was traffic lights, and there's a guy offering something through the window. So I'm having a look, and he said emeralds, and he's got this bag, and it's full of glittering green stuff. Anyway, the driver didn't speak much English, but he's just kind of gesturing to me, and then pointing up at the traffic light. And I realised that all of the lenses were smashed out of the lights, and it was like it was rubies yesterday. So the red lights the day before, and today it's the green lights for the emeralds. So, it's just, I suppose that's Africa, isn't it? But, I suppose other bizarre things, wherever you go in the world, I spent a lot of time in Mongolia and Indonesia, travelling for work. And, you come across some really interesting culinary things. I don't, this is a nation's cooking in some cases. It's just something we don't recognise. But had some glorious, deep fried, almost like fish nuggets that came out of and it was a puffer fish. Okay. So they sort of deep fry the whole puffer fish once they've taken out the bits that you can eat. So this thing comes out deep fried like a great big crispy balloon, and it's got all these nuggets in it, and you kind of wonder what exactly is that. But they tasted really good. Okay. I remember pulling some sort of bones out of morning porridge in Mongolia once as well, which didn't really appeal to me, so I just had the coffee that day. But the Mongolians just go off for it. They love that. So I was trying to conceal the fact that I was not going anywhere near it.
Not sure if I'd be game enough to eat a pufferfish. Just want to make sure that the chef knew what he was doing.
Just some of the weird stuff. Exploration camps can sometimes be the most bizarre places. I remember going on a visit somewhere, and we're probably 2 hours outside of a town. I got left to my own devices to look at some core one morning. I was visiting, we'd been overnight, and the person who was looking after me had to sort of drive someone reasonably urgently into town because he'd cut himself. This was all a mystery to me. I was just looking at core by myself and sort of absorbing it. Anyway, he got back and he apologised. No, sorry about that, mate, bit of an emergency. I said, what happened? He said, he cut himself. Oh, how'd he cut himself? He goes, well, he won't say, but the doctor reckons that it's a razor blade cut. Now, this was to a part of his body which some people shave. I don't. And
I think I know where you're going.
The story that came out later was that this guy who was a fieldy was sort of involved with the cook, and the cook must have been shaving him and nicked him, so he had to go to the hospital. So
Which country was that?
That was in Australia, but I won't be more specific.
Okay, just to keep the anonymity of whoever is involved.
But you asked for bizarre, so it's everything there.
That ticks the box. All right, thanks, Hedley. I think it's when you're out remote places, you tend to come across some strange things, and especially overseas. I mean, when you're on some of these sites, and a lot of these guys have been doing long rotations. So when we're in Zambia, we'd be doing 8-week rotations. So you do start to get a little bit stir crazy in that one little spot. So some bizarre things can certainly happen.
Well, people's focus comes out as well. So you can kind of, when someone's really just been involved and that's all they've been doing for a long time, you can sort of sense whether they got conviction or whether they're absolutely bored out of their brains. And I mean, I'd get bored. So, but you can. All the weirdness comes out, but that is often just their personality focused into a couple of things. And, it's nice to see the authenticity of people as well. I'm not talking about the shaving behaviours. It's more, there's a lot of bizarre things you come across which you wouldn't reveal about people, but it's getting to know them properly. And I think I value that, because you can sit across the desk from someone for an hour, go through a presentation, and you actually don't learn too much about them. They can conceal an awful lot. So seeing their bizarre behaviours often is endearing as well.
Yep, when you're living with them day in, day night. Absolutely.
Yeah.
Now, picking these sort of exploration stocks, I don't know if you like fishing. I've always kind of seen this as a bit of an analogy to fishing. You've got the hook, you've got you're trying to catch a fish, but a lot of these fish, a lot of these explorers, you might have on your watch list, and you might be sitting and sort of waiting for that stock to kind of come along and waiting for the right time to do an entry. And I think a lot of people sort of talk about their successes and what stocks they did get into, but are there any sort of particular stocks that you kind of wish that you did get? Maybe not recent ones, maybe in the past, you sort of wished maybe it was sitting on your watch list, you were just waiting for the right time, but it just, I don't know, maybe had a good drill hit and just the price got ahead of you.
Fishing gives me a horrible hangover, so maybe I'm doing it wrong, but I know what you mean. And look, there's two, I suppose, come immediately to mind. First one, Catalyst Metals. We looked at, I'd say it'd be a couple of years ago now. So we liberated a fair bit of money in 21 and 22. We went to 90% cash in our portfolio. It was as much opportunity as it was conviction. We thought we were at the top of the market, and it turns out we were right about that. So that enabled us to invest, as the market was weakening, particularly for small stocks. Catalyst came along, and Catalyst was buying or had bought the two companies or pieces of ground in order to consolidate the plutonic gold field in central Western Australia. Fairly famous field. There's a lot of gold come out of it, and there was big resources there. And the theory was you buy the mill, which didn't have much gold alongside it, and you buy the rest of the ground and pull them together, and you've consolidated something which should make a long-term sensible story. One thing that concerned me was it's a mining story. There's a lot to assess here other than just a development trajectory, and that's kind of where my comfortable skill set is. In mining, there's a lot more volatility, and your cost equation is in millions of dollars rather than hundreds of thousands of dollars per month. So, if you're getting something wrong, you burn through the cash quickly. The judgment was that James DeCrepney, who runs the company, was, the kind of guy who would, definitely back himself and then absolutely throw all of his energy into making it work. And he's done that. He bit off an awful lot, and he's chewed like crazy. And I think you can now see the fruits of that. But we stood back from it and said it's not quite the middle of our mandate. And it's mining, and there might be something which causes this to come back to us, and if it does, then that's when we would go. We missed that one, so I think the investment opportunity was about $1. I checked just before I came out; it's about $2.80 at the moment. So it's been a good almost 3 times. So I was ashamed to miss that. I don't regret it that badly, in that I feel very good for James that he's had that success. But at the same time, knowing that it was outside of our mandate is sometimes as important a reason to miss it. But it would have been pretty handy performance to have. The other one, though, we were observing the lithium movement from 2020, I'll call it 2020, right through, and since 2016-17. We thought the price movements were extremely severe, and we were very worried about that. So we were looking at lithium thinking, okay, well, we buy into this. It's a commodity of the future, but it's a challenging product to sell. And when you're in a market where you're trying to develop a project, sell a challenging product, and you have huge product pricing volatility, it's a recipe for very, very risky holdings. So we stood back from that. We'd thought about speculating in some of the exploration stocks that, at times in 2017 and then again in 20 and 21, if you said we're exploring for lithium, your price would go nuts. We thought about some of those and wanting to get into the ones that looked like they had half decent projects. as it turns out, I think, to mine lithium from a pegmatite in Western Australia, you need a reasonable width and you need a reasonable grade. There's a lot around, an awful lot around, but dilution with wall rock and things like that are massive issues, particularly from making a product's perspective. So we were watching that, and we felt really bad about having missed it, but then seeing how quickly and severely it came back in 2023, I think it was. I suppose we sort of rationalised that view to say, well, we might have made some money on the way up, but would we still be holding it? If you're holding 10% or something like that, it's very difficult to move it. There could have been some lucky saves, and one of the ones that we looked at and really considered was Azure, which made a fabulous discovery. Now, if you rank the best lithium projects in Western Australia, which is pretty much where they all are at the moment in Australia, you'd have to say that Azure had, the top one or two of the projects there. So we missed that. You've got to move pretty quickly to get on board one of those. So, and that means buying aggressively on market, which is again sort of outside of our mandate. But we would have liked to have, I think, been there for something like that. I don't know how we would have behaved having come over the top of the commodity price. And short-term holdings tend to be something that we struggle with a bit because we'd like to hold it for longer. I think we probably would have moved as we saw the commodity price coming, but at the same time, Azure was taken over, so perhaps that would have been the rescue. But we missed that one as well. We're now far better cashed. We were liberating cash at that time. We're not now. We're cashed. So hopefully there's not too many more regrets over this cycle.
And I guess as an investor, it's important to remember that there's plenty of fish in the sea. Just going back to that analogy, but it's important not to sort of get too caught up in the hype and sort of be patient. Wait for that opportunity. If you miss it, there's plenty more of junior mining stocks, and especially in this market, I think when you've got so many really discounted junior mining stocks, I think. Patience is
I agree, and I think particularly for retail investors, but this pertains to Lion as well. Understanding what your risk profile, what you're comfortable with, and even what you think your skill set is appropriate to in terms of investing is hugely important. Warren Buffett makes an analogy of this, and he calls it playing a no-strike game of baseball. Now, he's obviously never heard of cricket where you can't get struck out, and he probably doesn't have the patience to watch cricket, nor do I. A game that goes for 5 days. But I suppose the analogy, though, is you wait for the delivery that you can hit. Don't swing too high, don't swing too low, don't go for something where you'll be caught out, and in cricket, don't swing for something that could cut back on you and take out your stumps. The whole idea is to wait for the delivery that you can hit. And I think that's very much what has been on our mind in the last 12 months is we know what historically we've been able to work with really well, and we can see those coming into our price range. So that's when we want to be investing. And retail investors who watch the market might not feel that sophisticated about it, but buying high is a recipe for poor investment outcomes. So I think, even just standing back and trying to understand what the cycle looks like and then making your stock selection for a longer term when prices are low is probably an easier thing for them to do.
I think that's to you guys' credit. You have been, Lion Selection Group has been really patient over the last 2 years, and I think that will be to your benefit in this market.
Yeah, so it looks like it is. Yeah. I mean, we've invested almost $25 million, and I think that's on today's or this morning's spot prices. It's worth about 40 at the moment, and then plenty of cash on top of that. So I'm pleased with how that's working.
Absolutely. So now, just in terms of stock selection and analysis, and we look at geology, we look at sort of the mine engineering, sort of planning. It's all very black and white, a lot of figures, a lot of data. But as geologists, as sort of technical people, how much do you think intuition sort of plays a role in sort of getting into certain stocks?
Well, you don't want to be too much of a gut feel kind of person. I often scoff when I hear people say gut feel says this, but at the same time, intuition is the sum of all of your experience, right? And if you've got no experience in something, then intuition will mean nothing in that space. But I think when you've spent a lot of time doing something, particularly when you bring a specialist understanding to the space like you do with geology and me to a certain extent, although I don't rate myself as good a geologist as you were, James.
No, you are. Absolutely are.
You see things which will mean something to you, and that could be particularly when you've spent a long time in a business area, you know a lot of people. So that, I suppose, is one intuition. Benefit of being an investor like we are is that we have very broad networks. And if there's someone who's new to us, it's easy to check them out, but it's also easy to have a conversation where you're making statements, checking facts, moving around each other. And intuition can play a pretty strong role in people judgment there, I think. But I suppose the other one is, there's this adage across most commodities, but you hear it a lot in gold, grade is king. So someone intersects half a metre at 45 grams and they're like, well, grade is king, this must be wonderful. A lot of retail investors hear that and they go, oh, I'm being told the correct thing here. There's an adage which I can apply to a fact, and that must lead me in the right direction. I mean, my intuition is, if that half a metre intersection is 300 metres deep, well, unless it's connected to the surface by a series of other things, half a metre at 45 metres is 45 grams is probably not that great. But additionally, I mean, it's half a metre thick. You're going to have to take a lot of waste material with that. And I see stocks. There's one in our portfolio called Saturn Metals. It would be the lowest grade gold resource that's quoted of any volume or any true volume in Western Australia. It's 0.54 grams per tonne. But it's got about 6,000 ounces per vertical metre or more than that. So there's a huge amount of metal density as you go down through the system, and it's all in one blob. So the cost to get it out is very low. So in that case, grade is not king. Bulk, economics and metallurgy are king. Yeah. So, I think, and that's something that we picked knowing that it was very low grade, but feeling great about the geometries and everything else. So I suppose there's a bit of black and white analysis in that, but there was a lot of things at that time where all the adages push you in the other direction, but intuition was saying, no, this is something where you need to do the work. And when we did and looked at the economics, they're fabulous. So, I feel vindicated in that. But I think you've got to be careful with those things. And sometimes if you've got the experience, trusting that intuition is valuable.
No, I like what you said. So intuition is the sum of all that experience. So it is really experience and that technical background which sort of comes together.
Yeah,
I think that's a really good
and
point.
Seeing where people have made things work in the past that goes against adages as well. So the more you see, the more you realise that emeralds might be smashed traffic lights.
Absolutely. Yeah. Actually, so now I tend to look at commodity cycles. I have a really strong interest in seeing the boom to bust phases of commodities. I think they tend to ride in the same phase, even though they might have different demand-supply dynamics. Broadly, if we look at the last sort of big commodity cycle from the early 2000s, there was that broad sort of pickup in commodities from gold to iron ore to copper. Now, you guys are really well known for your clock, your mining line selection mining clock. So I think that's really useful for investors. I recommend getting on the website and checking that out. So I think it's at 4 o'clock.
Correct.
If I'm right?
Yep.
Yeah. So
yep.
4 o'clock, and I think that's sort of ticking towards mining sort of M&A activity. So more so mergers and then into acquisitions.
Yep.
As I believe. So I think that just speaks to maybe we are sort of moving to a more bullish phase in the cycle. I think you correctly picked over the last 2 years, especially for the junior mining stocks, that we're not here yet. It's sort of a time to be patient. So speaking of the clock, can you maybe just give us some more details and how it looks going forward?
Well, the clock concept dates back to the late 80s. So my father was the founder of Line Selection Group, and the clock is a concept which he came up with when he was a mining analyst at JB Weirs in Melbourne. And it's a simple depiction, so it's a cartoon, and we use it to show how the mining cycle works. And it's basically moving like from night to day, but in this case it's from boom to bust to bust to boom to bust to boom to bust to boom. And that's, you if you've got a long enough memory and you worked in mining, you know that it always goes from one to the other and back again. The interesting thing about that is that, mining is an incredibly capital intensive business, and it's the availability of that capital which generally results in wild swings in equity prices. But that of course is connected economically to commodity prices and the availability of capital. So what we do with the clock is to watch for various indicators as to whether liquidity, which is money, coming into the sector is coming or going. So at 12 midnight, that's like when Cinderella's coach turns into a pumpkin. that's when the bust begins. So that's the top of the market.
Yeah.
That ticks around, and it doesn't go at a constant rate either. I mean, a bust can take 10 minutes. In 1987, it didn't take very long. From 2011 to 2015, it took 4 or 5 years. But that ticks around to 6, and 6 is the bottom. So 6 is where the boom starts. It doesn't start to feel like a boom, but you start to see, the first swallows of summer, if you like. And the indicators which we're watching, things like IPOs, you can't get an IPO away in a crappy year for an exploration company. You see the numbers of exploration IPOs per year going up after you get to 6 o'clock through to 12. You see some big IPOs at the top of the market. You see some big takeovers and very aggressive takeovers in some cycles between 11 and 12. And sometimes I think that could be some of the behaviour that tops the market because buyer's remorse kicks in and valuations are examined very closely around big IPOs and around big takeovers. So, they're top of the market behaviours that you see, and then it tips over from there as investors particularly start to scratch their heads and wonder about what they've just paid for. But then as you're coming down the other side, the mining industry itself, I think, has often led the recovery of many markets. Now, whether that's just a participation or whether it's setting an example, you could debate. And maybe in some cycles it's been one and others it's been the opposite. But when the mining industry starts buying, particularly if it's paying cash for something, but then zero premium mergers where people are saying we need to be together for scale, they are classic bottom of the cycle behaviours, and between sort of 4 and 6 o'clock. So it's just before dawn. It's all the preparation for the boom to come, and it's not to say that they can read the cycle really well because capital deployment by mining companies typically is. It just responds to the cycle. It's not anti-cyclical. They tend to do a pretty poor job of that. But as far as acquisitions go, there are 2 times where they get aggressive. One through bullishness, and that's sort of 11, and the other through opportunistic, just seeing bargains, and that's at circa 4 o'clock, which is where we are now. So, BHP for Anglo didn't happen, but it was a bid. I think that's a classic, and there's a number of other examples as well in gold. Some of them are hundreds of millions of dollars worth, and some of them are into the billions. So, I think we're seeing that now, and they're not the kinds of deals where people are prepared to pay big premium. So you look at BHP's behaviour towards Anglo; it was quite disciplined.
That's right. And I think that's a good distinction. So you've got sort of a healthy, I guess, amount of M&A just starting to tick higher, but it's nothing like what maybe we saw back in 2011 where you had that. Just euphoria of M&A and just this hyperbolic kind of activity and companies paying far too much. And
well, you had BHP bidding for Rio at that stage. That might have been a bit earlier than 2011, but then Glencore came to market with an IPO in, I think it was April 2011, and then it actually happened in June. That happened within less than a month of the peak of the market. I mean, Glencore was a very, very richly priced IPO. So, what was it, about a US $11 billion raising, I think, to list on the LSE. If you've ever seen buyer's remorse or wonder what it looks like in a share price, look at the Glencore chart from 2011.
I think a lot of CEOs' heads cut or rolled after that big sort of hyperbolic M&A action in those big years. And I think this next question I want to ask you sort of relates to what we're talking about with. So we've seen gold, and gold is ticking past 2,600 per ounce in USD, and we haven't seen that sort of activity flow into the juniors yet. Would the M&A sort of cycle that Lion Selection is sort of anticipating, would that perhaps be that sort of final leg which starts to push up the juniors into the...
I think it'd be it'd be a very effective price transmission mechanism. And I think, if you look and listen to market chatter, I think that there is a lot of consideration of M&A going on in the gold space. There tend to be a lot more companies in the gold space than there are in, say, copper or any other commodity sphere. there are all sorts of reasons for that. But whatever they are, there's a lot of gold companies, lots of explorers, lots of miners, and lots of options for consolidation. So I think, in a place like Western Australia, it's always talked about, but I think there's a great deal of seriousness behind some of the consolidation discussions there now. But you're seeing it at a high level as well. So, there's that appetite there. And as that flows down, that's often what motivates retail investors. They see institutions getting excited about bigger companies, they get re-rated, then a smaller company gets taken over, and then it's who next. So that's important. I think, though, gold is a really interesting case study at the moment because there are several sets of buyers within the gold industry across the metal and the industry. Traditionally, if you go back to 2002 through to 2022, the price setter for gold was Western ETFs. They were the marginal buyer of gold. They consumed most of it. And if the ETFs were buying and accumulating tons, the gold price was going up. That was an almost perfect correlation. In 2022, that seemed to flip. Someone else started buying gold. And I think the buyer moved from being the Western ETFs to Eastern consumers generally. Now, the Chinese central bank was a big portion of that, but Chinese consumers, Chinese investors, Indian consumers and investors, other Eastern or BRIC, if you like, central banks were all participants. So that has priced gold in outside the paradigm of gold equities. Gold equities, sure, there are gold equities in the Eastern markets, but the vast majority of gold equities are priced in US dollars predominantly, or Australian dollars or Canadian dollars, but they're on Western exchanges. And that's a different class of buyer. They're not the ones buying gold. So they might be sitting back even selling gold or thinking, wow, this is a great price, but do I pay more for a gold company now? We've been waiting, I think, for that sentiment to catch up. But they're all institutions. Institutions are far better funded. They have liquidity. They can rotate money out of profitable positions like from tech. So if they decide, all right, now it's time for gold equities, I think you'll see a leg up then, but in producers. And then the question is, well, who are the buyers of gold explorers? At the moment, it's definitely not institutions. There are very few of them who have been active in gold explorers.
It's the crypto investors and the...
Well, it's your retail, yeah. And if you look at them over the last 2 years, they've become incredibly risk averse. And I don't think it's because the world has become a more risky place. I think it's because the world has become a more painful place for a lot of them. So if you think of your average mum or dad investor, they've got a mortgage, school fees, car loan perhaps, got to put food on the table. And I think that's eaten a long way into the disposable income that might have gone. Now, whether they're self-funded retirees right through to your 20-somethings, there's all sorts of different appetites, fundability, sources of liquidity. I'm talking very broad averages there, but I think that class of investor has maybe not tapped out, but has certainly been extremely restricted. So for the gold explorers to catch up, I think you need that risk appetite to return, and that'll be partially institutions moving into the exploration space. I think that'll be motivated by M&A for sure. And the retail people will come off the back of that. So it's a long answer to the question, but I think that's really the answer.
Yeah, no, that's excellent. And I guess one aspect to that, so gold supply, I read an interesting report from S&P Global just 2 weeks ago. I think they put it out. I'll just read out some stats here. Yeah. So just quoting, so from 1990 to 99, there were 183 discoveries. So these were deemed as significant discoveries, gold discoveries. Between 2000 to 2009, there were 120 discoveries. So that's a fair bit less than the decade prior, but that was, bearing in mind that the early 2000s was a lot of investment activity, so a lot more money going into exploration. But then we had the down cycle from after the early 2000s commodity boom. We had just 42 new discoveries. So that was about a 70% decline from that decade that's just finished in 2019 compared to the early 1990s. So how much is this sort of supply dynamic? Is that going to give gold prices strong support on any sort of pullbacks?
It's interesting. I think most people, if you ask them to present their anyone who talks about gold, not anybody, if you ask them to present their top 3 fundamentals on what might contribute to the gold price, I doubt that there would be much discussion about supply. there's a chart which I refer to from time to time. I can send it to you, and you can put it on the YouTube if you want. It charts annual gold production versus gold price, and plotting gold price as a logarithmic scale just helps to exaggerate it so you can see it from cycle to cycle. The high prices don't drown out the low prices then. It's not my original thought. This is just a chart that I've seen Crescat Capital out of North America plot. I plot the same one with similar data. So, and the interesting thing about that is that there are periods where the gold price either the gold production per year comes off, declines, or even just levels out. And the biggest bull markets that we've seen in that period of time, and my chart goes back to I think 1970 or perhaps the later 60s, the bull markets occur off the back of these flat spots. And the flat spots in production have generally been where, I think it was about circa 1970 or maybe the late 60s, South African production of gold topped and was declining rapidly. South Africa used to be the biggest producer of gold in the world by a long, long way. That mantle's been taken away, but South Africa was producing from underground, reasonably high grade, so process technology was not critical to recoveries and production. It was underground mining techniques that were crucial to that. The advent of CIP, so the ability to use cyanide in an agitated way with very finely ground ore, meant you could recover from extremely low grade deposits. So instead of needing 3 or 4 grams in an open pit, or maybe 2, you could go to 1. You could treat tailings. So the advent of CIP brought a hell of a lot of gold production to the market. Now that wasn't until 1980. So you can see this spot where there was an enormous gold bull market, very, very strong from start to finish, and that was sort of flat spot and constrained production. Once production kicked in, the gold price leveled. Now the interesting thing is that the gold price leveled at a time when interest rates were reasonably buoyant and gold companies were able to sell forward so they could hedge into forward sales. That was the form of hedging they used. It's a structure. And the forward price of gold that you get in a high interest rate environment is inflated from spot according to the interest rate. So, you could get astronomical prices by selling forward production. This became a financial product to them, and I don't think it was well understood, but the gold industry managed to sell forward in a period of about 15 years. They'd got to the point where the gold industry was producing X and was forward sold by X. So they'd forward sold by almost a year's production. So they'd have to produce for a year for nothing in order to clear those, which is financially unsustainable. When gold started to move, and again, off of a flat spot in production, so the CIP impact had occurred and gold production had flattened and gold price started to move up for a variety of reasons, but it was moving up. The hedges all had to be bought back. So there was this overprinting demand contrasting with supply. So as supply from the mines was massively going up, the miners were also feeding more gold in a sales sense by forward selling and depressing the price to some extent, I suspect. But then as that pinched, and they had to buy the hedges back, they contributed to demand on the other side. So I think that probably exacerbated the gold bull market that came off the top of that. The great news about that part of the discussion, though, is that for about the last 4 or 5 years, gold production has been flatlining. So annual increases or decreases have been more or less negligible. So we're now seeing the gold price go up. It seems reasonably robust. Everyone's talking about Chinese buying, Eastern markets buying, which is what I said before. I think it's, it will be supply constrained. There's no technological thing coming down the path at us here. You might see a bump in production and supply because you can drop cut-off grades and get at low-grade stockpiles and things like that, but they're not going to last very long. It's certainly not going to double production. It'll be a blip. So, I think that's an interesting construct. And I don't see a sense that the industry is going to hedge. Interest rates aren't really high enough to provide the incentive, and the capital markets desperately don't want to see it. So, I think that construct I think is really healthy for a gold bull market.
Absolutely, yeah. And you hear a lot about the copper supply constraints, but you don't hear much at all, as you said, about gold.
Yep.
Gold being perhaps harder to find or less production coming on board. But I guess the technology aspect is probably a bit of an unknown, whether that's new discovery techniques or more efficient processing techniques. So,
well, a new discovery. I mean, if you and I went out now and drilled a hole and we hit 100 meters at 3 grams, my suggestion would be we just sell it to someone. But I think wherever we drill it, we're probably in reality between 10 and 15 years from producing from that drill hole. So, does that shift supply? Not really, not in the short term. So I don't think exploration could shift that. People talk about supply coming from hoarded gold because, of course, gold doesn't get used for anything except for holding doors open in some retirees' homes. Not as an obvious bar, but something painted. But I mean, more commonly, it sits in vaults.
Yep.
And so the concept is when the gold price goes up, this all comes in as supply to meet demand. I think the notion just is, though, that it doesn't. I know it could, but it generally hasn't. Yep. So you tend to see that keeping being hoarded, and the supply, which interacts with actual demand, is far more out of production sources than it is from anywhere else.
Yeah, no, very good. Alrighty, I think we're getting close to time, but we're recording on 25th of September, and last night there were some big moves in futures. China yesterday announced a big stimulus package. A lot of resource stocks, understandably, ticked up pretty quickly on that news. And we'll probably see a few more fairly bullish days in resource stocks. I guess it's very early days, and we can't give a definitive answer on what happens next. Is this the big transition or the big breakthrough, I guess, that resource investors were hoping for? The big China stimulus package,
which
is
at the bottom.
Is at the bottom, yeah. So is August going to be that month where we sort of look back in a year or two as the prime buying opportunity for resource stocks? So how, Hedley, it's the $1 million question, but how do you think we are positioned in the market with that latest news?
Yeah, well, I mean, it's very fresh. So how the rubber hits the road and how the details of that stimulus work out, we'll have to wait and see. I think there's a very good chance that I think it'll be very influential. Whether it turns the market, I'm not sure. You'd probably have to break that down across a few key commodities. The fundamental that we talk about as having a huge impact on future commodity prices, but particularly the criticals, is the energy transition. So copper leads the way in that. There's a whole long list of them. And a lot of those have weakened significantly since 2022. Lithium was a big one, but copper is off. A lot of them are off. I think that's probably reflecting the much, much slower uptake and deployment of all the places where those commodities would be used. So demand has not materialised to the extent that was expected, and that's playing out in price. I think that's probably connected to the actual condition of the Chinese and US economies. I mean, the US economy is not in recession, nor is it really in great condition. It's roaring on some measures, but it has really creaking weakness, and that breeds a lot of uncertainty. So that's one factor. On the other is the Chinese economy, and they're trying to prop that up. Stimulus is not something which is natural. It's a synthetic, and it's a heavily managed economy. So it'll be interesting to see how that works out. So if these two economies are going to combine to create that draw for all of these critical materials to come through, I suppose off the back of where those economies are sitting at the moment, that's more likely to cause inflation, which is a bit of a dirty word at the moment because it leads to interest rates. So, there's kind of a cyclical, will it bring itself undone again? Or as the rubber hits the road, does it end up pushing things up, or does it just stabilise? So I suppose my mind is more towards that. Outside of the criticals, though, I mean, you've had a huge impact of coal pricing over significant numbers of cycles. Coal is something which is being sort of pushed away by a lot of parts of the capital market, and its consumption is becoming. Well, I suppose there's a movement away from it. That's what the criticals are about. Iron ore. That's touched $200. It's in the rear vision mirror now, but it's plunged through 100. There's a significant source of supply of iron ore coming on in West Africa, which is partly Chinese owned, partly Chinese sponsored. I think if I was a Chinese consumer of iron ore, I would desperately want that coming to market because that's going to cap the price far better than anything else that you can do in the iron ore market. So, if iron ore is something which has had a correlation to the general health of the mining sector in the past, well, that's probably going to keep a bit of a lid on things as well, until things like criticals come to the ascendancy for being what really drives market sentiment. So a turning point in my mind is unlikely to be a V-shape. I think, you've had the down, and it's been a fairly moderate down. It hasn't been a steep, aggressive, very quick. It's been hard for the CEOs of exploration companies, but you take away liquidity for 10 minutes and that's what happens. In this case, I think that there's a possibility of rounding off and things not getting too much worse. But will liquidity come flooding back? I think that's the big question, and that is still down to the sources of liquidity. Will we see institutions flooding into the space? I don't know. Their best source of capital is probably going to be rotating out of tech stocks. There's a lot of money caught up there, but it's also seemingly on a good thing. So probably not quite yet for that. Retail investors, we need interest rates to come down, I think, before they start to feel like they've got the disposable cash. So I tend to think that it could be a turning point, but into, you've come off the mountain and you're on the flats.
Will liquidity come back? That's a big question. I reckon
That's right.
We should probably leave it there. So thanks a lot, Hedley. If you're looking to get some more insights from Hedley, recommend going to his website, Line Selection Group. Also listed, ASX ticker
LSX.
Thank you.
Yep.
All right, thanks a lot, Hedley, and look forward to chatting again soon.
It's been great to chat to you, James. Thanks for having me in.